In May of 2026, Salesforce reported a record first quarter. Record revenue, record deals, record cash flow. The headline number was $11.1 billion in a single 3-month stretch. That was up 13% from a year earlier. Agentforce, its product for selling AI agents to other companies, had more than tripled its annual recurring revenue. So you would expect the stock to climb. It did the opposite. Salesforce shares had already fallen about 30% heading into the quarter. The results did not erase the market's skepticism. On June 17th, the stock closed at a 3-year low. Keep 2 facts in your head at once. Salesforce is enormous, profitable, and still growing. Its total workforce had also reached a record. Yet its support operation was 4,000 roles smaller, and its engineering team had stopped growing. The market saw both of those things, and marked the stock down anyway. That is the puzzle. How does a company post record first quarter numbers, prove that its biggest bet is generating real revenue, and still trade lower on the year? What is Wall Street seeing that the earnings call does not say out loud? And underneath the money, a quieter question. When a company this rich can grow while shrinking support, holding engineering flat, and hiring elsewhere, what will every company that copies it do? Start with the record, because the record is real. The cleanest number is the one nobody argues about. In its first quarter of fiscal 2027, Salesforce brought in $11.1 billion, up 13% year over year. Its own press release called it record revenue, record deals, and record cash flow. $10.6 billion of the 11 came from subscriptions and support, up 14%. Those contracts form the recurring base of the business rather than a single quarter of product sales. Salesforce also kept more of each dollar. Operating income came in at $2.3 billion, up from $1.9 billion a year before. Net income was $2.1 billion, up from $1.5 billion. Diluted earnings per share reached $2.42, up from $1.59. By nearly every line on the statement, the company was making more money on every dollar it took in. Then there is the engine everyone came to hear about. Agentforce. The pitch is simple enough to say in a sentence. Instead of hiring more people to answer customers, or process cases, or handle routine work, a business buys AI agents that do it. Salesforce said it had delivered 3.8 billion of what it calls agentic work units to date. And the money followed. Agentforce annual recurring revenue crossed $1.2 billion, up 205% from a year earlier. It was the first time that number had ever been above $1 billion. On the earnings call, Mark Benioff, the chief executive, called agentic AI the biggest growth opportunity for Salesforce and its customers. Agentforce did not stand alone, either. Bundled with Salesforce's data business, the combined AI and data run rate reached about $3.4 billion in annual recurring revenue, up over 200%. The AI story was not one product having a good quarter. It was a whole new layer of the company coming online at once. There is one more number that matters, and we will come back to it at the end. It is the backlog. The contracts customers have already signed, but Salesforce has not yet delivered. That figure, remaining performance obligation, stood at $67.9 billion. Think of it as revenue that is spoken for. A company with a backlog that size is not about to run out of work. So on the surface, everything is pointing up. Revenue, up. Margins, up. The AI product, up 200%. If the story ended here, it would be a victory lap. If you find this kind of business story useful, subscribing is what tells me to keep making them. The same results carried a second storyline. Support was smaller, engineering was flat, and new headcount was going mainly into sales. The cuts did not start with this quarter. They had been running for the better part of a year. Go back to September of 2025. Salesforce revealed that it had cut about 4,000 customer support roles. Benioff did not soften it. He told the San Francisco Chronicle, quote, "I've reduced it from 9,000 heads to about 5,000. Because I need less heads. 9,000 support staff, down to 5,000. He explained the mechanism, and this is the part worth sitting with. Roughly half of Salesforce's customer conversations were, by then, being handled by AI agents rather than people. 50% software, 50% human. The company said its support costs fell about 17% as a result. What makes that moment sharp is what Benioff had said only weeks earlier. In the summer of 2025, he had told Fortune that AI would not wipe out white-collar work, that it augments people rather than replacing them. Then, that autumn, the support organization was 4,000 roles smaller. The layoffs kept coming. In February of 2026, Salesforce cut fewer than 1,000 more roles, spread across marketing, product, data analytics, and other teams. But here is a detail the collapse framing tends to skip. Even after those cuts, Salesforce's total headcount was a record, north of 83,000 people. Corey One's analysis called it a reshape rather than a company-wide shrink. Then came June. And this is the round that got the dramatic headline. Reporting said the cuts had reached Agentforce itself. An AI company was supposedly laying off the people building its AI. A regulatory filing in California listed 86 positions, with more cuts in Washington state and overseas. 86 is a floor, not the whole number. It is a single state's disclosure, not the global total. So it is a real signal. But it is also where the easy story and the careful story split apart. Because when reporters looked closely at who was actually cut, the tidy headline did not hold. The June round hit MuleSoft, Marketing Cloud, and some roles adjacent to Agentforce, not the core team building the Agentforce product. The California filing spanned sales, administration, and technology. One outlet, Refoke, went further and argued the whole framing was wrong. It said this looked less like AI eating its own product team and more like an ordinary consolidation. A MuleSoft clearout dressed up as an AI parable. And Salesforce itself never said AI was the reason for the June cuts. The line that AI was devouring its own builders was an inference drawn by the people covering it, not a claim the company made. Accuracy changes the meaning here. The seductive version has a robot firing its own maker. The documented version is quieter. Salesforce did not need to lay off the people building its AI to change how many people it employed in other functions. It was already doing that in support. To see the real shift, you have to leave the layoff headlines and go to a single sentence on the earnings call. Benioff was asked about engineering, the people who write Salesforce's software. And he said the engineering team had stayed roughly flat, at about 15,000 people, for around 2 years. Same size, while the company kept growing. His explanation was blunt. Quote, "The reason it's been mostly flat is because we have been using AI to create more efficiency for our engineers." That one sentence carries the argument. Nobody was marched out. There's no dramatic firing here. The engineering team simply stopped growing, and stayed stopped, because the people already there, with AI helping them, could cover the work the next hires would have done. That is a different thing from a layoff. A layoff is a number that goes down, and it makes the news. This is a number that just doesn't go up. The hire that never happens. The team that would have been 40 people and stays at 30. It leaves no filing, no headline, no severance line. At the scale of Salesforce, that quiet constraint can affect many future roles without a single layoff notice. Salesforce's total workforce was not shrinking across the board. It had climbed above 83,000 people, a record. Benioff said the growth was concentrated mainly in sales, where people still had to communicate, persuade, and reach more of the market. AI was not reducing every function. It was changing which functions the company chose to expand. Now, a caution, because this is where it is easy to overreach. Benioff is describing his own company. In his own words, at an investor event where flat headcount and rising efficiency are exactly what shareholders want to hear. He is not a neutral narrator. And Salesforce has not claimed that AI is the sole cause of any single job that disappeared. Some of what happened in 2025 and 2026 is ordinary corporate reshaping, the kind big companies do in every cycle. AI or no AI. So hold it as analysis, not proof. The claim is not that a machine took 4,000 support jobs in one clean stroke. The claim is narrower and better evidenced. Across a year, the mix of who does the work shifted. Half of customer conversations moved to agents. Support costs fell about 17%, and the team that writes the software stopped needing to grow. Put those together and the pattern is clear. Salesforce produced more output with less headcount growth in support and engineering. And Benioff has put a rough size on it himself. He told Bloomberg that AI already does somewhere between 30 and 50% of the work at Salesforce. Sit with that range for a second. Not 30 to 50% of some pilot project. 30 to 50% of the work. At one of the biggest software companies on earth. Said out loud by the person running it. Whatever you think of the exact figure, that is not a forecast about the future of work. It is a description of the present one. That is the labor math. Investors were applying the same concern across the software sector, not only to Salesforce. Come back to the puzzle we opened with. Record first quarter. AI product up 200%. In a stock that Wall Street had already knocked down about 30% on the year. Why? Part of the answer is hiding in that backlog number. Remaining performance obligation. The signed, not yet delivered contracts grew 11% to $67.9 billion. The nearer-term slice of it, what Salesforce calls current remaining performance obligation, grew 14% to $33.6 billion. Both grew, and both came in just under what analysts had been modeling. The current figure landed at $33.6 billion against an estimate near $33.7. A small miss, but on a stock price for the future expectations carry unusual weight, and the backlog had grown a hair slower than consensus expected. Salesforce's own guidance for the year pointed the same way, framing full-year growth of roughly 10 to 11%. Solid for most companies, but a step down from the pace investors had gotten used to. Its guidance for the next quarter landed below what Wall Street was looking for. Now widen the lens, because Salesforce did not fall alone. Between late December of 2025 and March of 2026, its shares slid from about $265 to $183, down roughly 31% in 3 months. The record quarter did not reverse that repricing. The shares remained down sharply on the year as investors weighed slower guidance and AI-native competition. That slide was part of something analysts started calling the software-as-a-service apocalypse. The main software stock index fell about 30% from its September 2025 peak. In January and February of 2026, roughly $1 trillion of software company value was erased, the sector's worst monthly decline since 2008. The market re-rated the whole category. The multiple investors were willing to pay for $1 of Salesforce earnings compressed from about 35 times to about 23. The average analyst price target fell from around $360 in the spring of 2025 to about $267 a year later. Here is the argument the market is making. In plain terms, for 20 years, software grew on one promise. Companies would keep buying software licenses for more employees every year. That is the model AI now threatens from both ends. If AI lets Salesforce's own customers do more with fewer people, then those customers need fewer licenses too. The tool that makes Salesforce more efficient can make its buyers less hungry. That is the fear priced into the stock. Salesforce's capital plan added to that mature company reading. Alongside the record quarter, it launched a $25 billion accelerated share repurchase. Its filing also showed $25 billion of new senior notes. A repurchase returns capital and reduces the share count. It does not, by itself, prove that management has run out of ideas. But investors could see a company directing enormous resources toward financial returns while its growth guidance settled near 10 or 11%. By the middle of June, the stock had touched a 3-year low. Now, the fair counterargument, because the bears do not get the last word for free. You can read all of this the other way. A backlog of nearly $68 billion is not the shape of a business about to shrink. Agentforce just crossed $1 billion in recurring revenue for the first time, growing 200%. Rising margins on record revenue is what a durable, disciplined company looks like, not a dying one. It is entirely possible the market has overcorrected, and that the same efficiency spooking investors today is exactly what makes Salesforce more valuable in 5 years. That case is real, and it may be right. Whichever way that bet breaks, the operating change is already visible. Salesforce posted record first quarter results while running a smaller support organization, holding engineering flat, and expanding sales headcount. More money, but a different payroll. The wrong version of that story is the robot firing its own maker. The real version is slower, and it does not need a villain. It is a company using AI to make the people it already has go further. So the next hire never gets made, and the support desk gets smaller, and the headline never comes. Salesforce is big enough, and Benioff blunt enough, to put the change on an earnings call. Every other large company can run the same calculation. Which jobs still require more people as revenue grows? And which teams can stay flat while software absorbs the next increment of work? The layoff made the news. The larger story may be the hire that never happens.